Welcome to Smokin Bulls, the podcast about business, money, and lifestyle. Today we're here with Dr. James Thorne, Chief Market Strategist for Wellington-Altus Private Wealth. I'm Tyler.
I'm Dave.
Let's get into it. Dr. Thorne, maybe you can share with us a little bit about your background and do a little bit of your own personal introduction to share with us your background and how you got into doing what you do today.
Sure. So I grew up in Toronto, and I'm old enough to remember when Toronto was a small town relative to Montreal, and grew up in the 60s and the 70s. I got a PhD in economics and finance. I taught at Bishop's University, which is when I got my PhD, in the Eastern Townships, just south of Montreal. Came back, learned the business of the markets, stock market, equity markets. And then I got hired away and I went and lived in the United States for about 20 years. And I ended up being the chief investment officer for a major US financial institution. Decided to come back home. And I've been home in Canada for about 4 years. And so I ended up living in the Washington, D.C. area, therefore, hence somewhere I have my Washington Capitals hat. But, grew up as a Leaf fan and got my heart ripped out because the Leafs were terrible. But I really start from the top down. And when I look at the world and I look at it, the historical perspective, because context is so important. And then from there, I've taken all the accounting and business and finance classes. And so, we can go down and drill and look at the companies and so on and so forth. So that's kind of where I am. I'm an odd duck. And it's great to be back in Canada.
Well, thanks for that, Jim. Now, you've got obviously a depth of knowledge. And what Dave and I have realized being with Wellington-Altus is you've got a massive following. There's a lot of people that read your articles, read your newsletters each week. One of the topics that's started to creep into your newsletters is modern monetary theory. And a lot of people don't know what the heck that is. Dave and I even struggle to wrap our heads around it. So MMT in shorter terms is becoming, what you say is becoming very prevalent in governments around the world. And whether or not it will work is a debate. So we'd like to learn a little bit about that from you, and our viewers would probably like to learn a little bit about it from you. So if you can dumb it down into terms that we can all understand, that would be great, and share some of your insights on it.
Okay, so let's start from the assumption that the majority of economic theory that we know of and we're taught in school is wrong and is useless. Okay. And everybody laughs, but but when you think about what we do and how it is framed in the media and the politicians, what we do is we say that the government has a budget, and that budget is exactly the same as you or me or a company, where we have to match money coming in with bills going in and pay them. And so there's got to be a budget, and we can't spend anything more than we don't earn, right? And we apply that to governments. And that view started coming out of the hyperinflation in the 1920s. And my premise through all of this is, let's not argue, let's just build the context and move on. What modern monetary theory says is that basic assumption that the federal government, a government that can print its own money, has a budget constraint like a household, is wrong. And what we need to do is we need to start off with the end in mind. Let's say, do we want to have a great healthcare system, or do we want to have a great education system, or do we want to tackle climate change? Start with the end in mind, and then the federal government, because it can print money, can expand its balance sheet and expand the deficits. And what will happen is, as the real economy picks up, it will be when the demand for goods gets so much greater than the supply of goods that inflation will happen. So what the modern monetary theories, or MMT people, are saying is, just think about this. The last 5 years, we've had zero interest rates at zero, and all we've heard about is deflation. right? They say that you can expand their balance sheet. So the Bank of Canada, Justin Trudeau or President Biden can expand and spend as much as they want. And it will be when the economy overheats. And that's when inflation will kick in. So in fancy talk, is modern monetary theory assumes that inflation is a real phenomena where you get a mismatch between real goods, the demand for real goods, and the supply of real goods. Whereas what we've been taught before, it's a monetary theory, right? That's why we have to control the growth of the money supply. So what they're saying is, look, we have not been able to kick this inflation problem or deflation problem. Let's start spending. And in the United States, which is a very different than Canada, there is a big edge that's different. When we moved down to the States or to we lived in the Washington, D.C. area. I lived in a beautiful golf course community with all the Washington Capitals, right? But if you went a mile down the road, you saw abject poverty, right? I cannot explain to you the stark difference between the haves and the have-nots in the United States. And so if Biden is going to achieve these goals that he wants to, and if the United States wants to basically tackle climate change, education system, healthcare, the only way they can do it is pumping massive amounts of money and accumulating massive amounts of debt. That's and my suggestion is, let's not argue about it. So when you hear people sit there and say, we need to figure out how we're going to pay for this program, that is wrong. And that is the old way of doing things, according to those people that are supportive of modern monetary theory. I take the position, which has been beaten into my head for being in the business for so long, is, let's not argue about what's happening. And let's suggest to you that the rise of populism and what happened with Mr. Trump and the Brexit really started. It started in the 80s with the hollowing out of the manufacturing sector. I can take you to areas of Southern Ontario that used to be manufacturing center. It's dead. Massive amounts of fentanyl and drug use. And that's all through the middle part of the United States. What lit the fire for populism was the fact that after the 2008 financial crisis, Wall Street was bailed out, and all of the austerity measures were basically jammed down Main Street's throat. And that started the Tea Party movement, and that really started this populist movement. And guys, I talk to my friends in the States all the time. In fact, I was watching the Rangers Capital game last night and texting my friends, and complaining how everybody thinks the Capitals are now the Philadelphia Flyers.
The goons of the 80s back.
The rise of populism has not gone away because Mr. Trump is no longer in the White House. I would suggest to you it's even more intense. So Mr. Biden understands this. I think Mr. Trudeau understands this. And so I suggest that we are in a period of time, and this is what the central bankers talk about, is we're in a period of time like 1945 to 1951, where we are going to go through a major reconstruction bill. Deficits are going to go substantially higher. And if that is the case, and deficits are going to go higher, and inflation will kick in when we overheat the economy to the point where demand is greater than supply. I mean, you guys are in Alberta, right? You guys understand commodities, right? When the demand for oil is greater than the supply of oil, right, the price of oil goes up. Use that simple common sense theory for the rest of the economy, right? Yeah. So we're going to be in a period of time where the policymakers are going to try to achieve strong economic growth, and they're going to spend like there's no tomorrow. And my suggestion to you and to your listeners is, don't fight it, right? You're going to have a massive debasement of fiat currency or money, and you're going to have a massive printing of bonds, protect your portfolios accordingly. Don't argue about it, just do it, right? To use the old Nike saying.
So when you see this happening, and I get the sense of what you're saying is, look, you could fall on the other side of this and say this isn't the right way. That's not going to matter at this point. It's going to happen. So therefore, get your own house in order, get your investments, get your strategy, get your sense of what's going to be invoked in the next few years. Just line yourself up for it, because it's going to happen.
Yes, sir. Or let's use hockey as an example. Hey, the refs calling the game differently, right? We're going to go into the playoffs, right? We go into the playoffs, and you know what? The Capitals are built for the playoffs, where the whistle's put in the pocket. Hey, you guys lived through the war in Alberta, right? Between the Flames and the Oilers. It's a completely different game. Don't argue about it, right? Just realize that the rules are going to be called differently and invest accordingly, and don't complain, right?
Well, and I would agree that things are going to happen. To what extent, to what dollar values? I mean, we've talked before, and we've looked at other things, and we're in the trillions of dollars is going to get spent. I mean, what is the hangover from all this? What is the downside? I mean, maybe you get some forced inflation, which should happen, but what's the fallout that nobody sees, or that the arguments over about this is going to happen? No, it's not.
Well, eventually, what will happen is we'll end up like a decade like we'll have in the 1970s, right? But if they did this between 45 and 51 after World War II, where the Federal Reserve expanded their balance sheet by 10 times. We've only expanded our balance sheet by 4 times. And public sector investment as a percentage of GDP was like 25%. It's now like 16%, right? So you have this period of massive economic growth, and hopefully we have a golden era like the 50s and the 60s. But eventually it has to. So the statement I always say, deficits don't matter until they do, and they will, just not now. So if I'm living in if this is like 45 and 50, and it's not going to be into the 70s, I may not be alive when we have to pay the piper. That's the kind of context. If we got into Michael J. Fox DeLorean and drove back in time, right? What's very interesting, and you get back to the 40s and the 50s, the same conversations were going on here, different labels, right? We had to retrain a workforce. It was the GI Bill. There was the rise of populism. There was an extreme amount of concern about socialism and communism in the United States and in the Western world. I mean, Henry Wallace was FDR's vice presidential candidate that got taken out in the 1944 election, and Harry Truman was put in. Harry Truman was as old as Joe Biden. I can go through the parallels are stark. But what I would say to you guys, if I put you in that DeLorean, knowing what you know now, and going back to 45 to 51, how would you invest? Knowing that it wasn't until the 70s that basically you had to pay the piper. Yeah. Right. So I don't. So the time frames and everything happens in such a condensed time frame right now. What I'm saying is, President Biden knows that Donald Trump wants to run in 4 years. And President Biden understands that he cannot make the mistakes of what the Obama administration did by trying to get a bipartisan solution, and also not focusing on Main Street. And I think President Biden has the wisdom and the foresight, and also the Constitution to do this. And so he is going to single-handedly expand the balance sheet or the deficits to make sure that the United States, and we move towards a green environment, to make sure that there is health care in the United States, to make sure that there's money for the education system, and to make sure that people get retrained. And so that's what his legacy is going to be. Let's not argue about it and just get prepared for a massive deficit expansion.
And so I think let's just keep going along with this. And this is the way it's going to be. Alberta is, very commodity based, very agriculture based, becoming a bit of a tech hub. I think anybody in any community would say they're becoming a tech hub. But let's face it, you've talked about a commodity super cycle and the fact that in order to get green, you're going to have to dig up a lot of stuff to get there. And, I think Alberta wins when this happens. I mean, we're from Alberta, so obviously we're concerned about that. But I think, Alberta's kind of kicked in a lot of green that most people don't even think about. Their technology and directional drilling and fracking, I mean, comes into play here when you start dealing with some of the green options out there. So it's, how does somebody participate in this massively expanding spending economy? What do you think is the best ways to look at this?
So I think what you've got to do for the investors and thinking about it is just recognize the fact that we're in a new environment, and the changes that we're talking about are going to have to take decades to basically for us to see the results. So the way I look at the energy and go back to the last super cycle, right? I can remember when in the early 2000s, when we talked about the urbanization of China, the folks from Imperial Oil and all the majors in Alberta said, we're using $30 oil as our long-term base case for capital expenditures. And remember, the first 4 or 5 years, they didn't expand capital expenditures, right? And they printed money, and the cash flow was wonderful, and they paid down debt. They bought back stock, and they paid a dividend. That's going to happen again. There is no way that they're going to spend on CapEx. So what I would suggest, so when I sit there and think about this, I think the cycle is going to play out. You've nailed it, the nail on the head. The irony about all of this is that to get green, we are going to have a commodity super cycle, and it's going to be wonderful for Alberta. Here's the point, though. You're not going to see the massive growth stage for a while in terms of new ideas and new CapEx. And let me phrase it this way. I think the prime energy targets now are going to be what are called short cycle or the shale plays. Something that you can go get in, get your money out in a couple of years. Any massive expansion of the oil sands, guys, I can remember when it was called the tar sands, and the commercials were on Hockey Night in Canada, right? And it was Syncrude, and you had don't get me going, but the massive expansion in those mega projects are going to get on hold until we get oil over $100, right? And it's going there, guys. Yeah. Right. We'll talk. It's not tomorrow, but look at the economy is going to, if they pump the money out that we think it is, and we're going to get the growth that they want to get. And then you have, really serious, smart people managing, oil companies. Right. And I worked as a summer student. I paid my way through grad school working at Imperial Oil, at the Treasury Department at Don Mills in Eglinton, working on their mainframe computer. They're smart guys and gals. They get this. There's no way they're going to expand CapEx for a period of time. So first off, you just got to make sure you guys have commodities in your portfolio. And it's going to be very hard for the majority of people because, guys, our industry chews people up. The average portfolio manager in this industry is 7 to 8 years. That's it. They have no memory. So when you and I and our guys, we're talking about the last cycle, they've been in this business since 13, and all they've been able to do is buy FANG stocks and ignore commodities. They don't know what a commodity super cycle is. Yeah. Right? And so for us that are older, this time it's not different. And the terms are going to be different. But, the real concern is going to be, look at copper. There's not going to be another copper mine built. There's no way they're going to build another copper. What is going to happen? When you think about this, what happens when oil gets over $100? And let's just say hypothetically in a couple of years and people are screaming, what's the CEO of Imperial Oil or C&Q going to do? right? They're going to say, ESG, well, the way we've got this legislation set out, our demand's going away in 10 years. Well, why would I want to spend? I'm going to act like a tobacco company did, right? And then that's what Philip Morris did. So I don't know how it's going to play out, but what I do know is this, right? There's enough cars on the road, and the emerging market is so dependent on fossil fuels. If you think we're going to basically not use coal and oil over the next 30 years, I got some swampland for you. Okay. Okay.
Yeah.
And so it's a huge opportunity. I don't know what happens in terms of what the majors do with all the money they are going to print. The free cash flow yield of these companies is going to be over 12%, which basically means they can pay down all their debt and buy back all their stock in 4 years. Right?
Which is
so
phenomenal.
They're going to have to do something, right?
Yeah.
I'm trying to get people to understand maybe you should reduce, the only game in town isn't the digitization of the global economy. Get back into real stuff, right? Same thing with food. Look at the price of lumber. Look at your rate. The only way we really get out of this to get to net zero is through nukes.
Yeah.
Right? Through nuclear.
So how would you recommend? I mean, for us, we work with our clients. We find ways to put pieces in our portfolios. How would you tell somebody, how do you participate in the commodity super cycle in a very easy way? Well,
do you have, we're talking home field, right? Right. Mm-hmm. I say, do you have do you have and I will give you names. I haven't done analysis on them because I'm a macro guy, right?
Yep.
But sometimes we make this too hard. Do you own C&Q? Mm-hmm. Do you own Imperial Oil? What are the big majors that are going to be great? What are the big? What are the really good mid cap names that are focused on in the Montney? Do you know what I mean? Yep. What are the great companies, right? What are the and so I don't think you have to at this early time in the cycle. I don't think you have to be too fancy. And if you don't, here's the easiest way. These new guys and gals that have come into the business, what they've done is they've just basically ignored Canada for 8 years, right? You don't have to invest in the United States.
Yep.
So materials, if you look at the S&P 500, there's 3% in materials. And that includes chemicals. So that's like copper, coal, chemicals. And then you get 3% in energy, right? Which would be oil and natural gas, right? The TSX has about 13% in energy and about 13% in commodities. A really easy thing to do is to buy the TSX.
Yep.
Right? Sell some, and they've got some wonderful, the Canadian banks are still wonderful. You get a nice exposure that way. My whole thing is just however you want to get the exposure, given who you are, given what sits right with you, is something that you need to have a conversation with you and your client. But right, and then for me, it's different, right? But what I can say emphatically is we're in a commodity super cycle. It's completely ironic. You do not want to sit in cash, and you do not want to own bonds. Right. Other than that, you guys can figure out what you want to do. Right. And you don't have to only own tech.
Yeah.
Right. Now, you might want to own tech as in the commodity company. Right. Sure.
Yeah.
Right.
Can you own green by owning a commodity company?
You can't. But this is a great conversation. Right. The thing that I would say to you that is very interesting is when we have conversations is when you buy a green ETF, right, or an ESG fund, look at the underlying, what does the ETF own, right? And majority of these funds own solar stocks, right? You want to own a little bit of the solar stocks or a wind stocks, that's fine. But I think there's better ways to play it. I think you got to own copper, right? I think, if you don't want to own Tesla, Ford and GM, right? Because this is no longer about electrical vehicles concept. This is about proof. This is about proof of concept. This is about proof of scale, right? GM, Ford. You don't have to, Magna, right? You do not have to go crazy, right? You don't have to, because we're in this theme, you don't have to buy these crazily valued, innovative companies that, some of them may work, but a good rail company would work. A pipeline company would work. You don't have to get too crazy, right?
Nice.
A bank that is exposed to Western Canada might work.
Well, and
relative
I think
to a bank that's exposed to Eastern Canada, that might be an idea, right?
Wow. And when I think of ESG, sometimes you always have to decide, someone who's, determining the governance, is at what point do you draw the line? Is a bank that loans to energy companies, are they off the table? Where is this line? And I think that's where people get confused, is they think they're buying, solar and wind farms when they buy ESG. But in truth, you could be investing in certain companies and they have some exposure to all of these non-socially accepted holdings. So I guess every fund is done differently, and the ESG guidelines are a little bit scattered sometimes. I know there's different groups that you can tag your fund and say, I subscribe to this doctrine in this box that I'm going to stay within.
Yes, and it's a marketing ploy, right?
Mm-hmm.
The ESG, it's a marketing ploy for actively managed fund companies to try to maintain some assets, because they're being cannibalized by passive investing, right? Yeah. And so you really it's called green mailing now, right? I mean, it's what you talk about it, and yet if you listen to the calls of Shell or British Petroleum, or you look at what ExxonMobil is doing, these companies are run by really, really smart people, and they understand where the puck is going, to use a Gretzky, and skate to where the puck is going. If they're going to convert, carbon trading is going to be big. They will adjust and they will evolve. I do not think it would be smart to count out those folks that run major oil and gas companies that's just sitting on their hands saying, we are not going to evolve with the rest of the world. So, nice. I think we sent out an email today. If you think everybody who's investing, ESG, or I am not going to invest in an energy name, and it's really easy to say that when all you have to do is put 10% of your portfolio in Amazon to outperform, to keep your job. When all of a sudden, all the energy names start flying and the earnings are growing, and everybody goes, well, maybe I'm not. I shouldn't be so harsh on these guys, right? Yeah. And we are so early in this theme, and this is why I'm trying to be so emphatic, right? And to shake people up. This is exactly how I felt sitting in 450 Park Avenue. In 2002, we had 20 portfolio managers in a room, in the boardroom. 5 of us were from Canada. Goldman just came in and pitched that China was going to be urbanized, and it was going to be a commodity super cycle. And they looked at, and we sat there and said, we've been hearing this for 10 years because China has been up in Canada. Basically, all these companies have been using the Canadian markets to basically finance their investment. So in the 90s, we had beer companies and tire companies and early adopters going into China. And what I didn't know then, in hindsight, was the fact that, after 9/11, right, the deal between the Americans and the Chinese was, the Chinese were going to vote to allow the United States on the Security Council to go into Afghanistan and the Middle East, and the Americans were going to allow early acceptance of China into the World Trade Organization. And if I knew at that point in time that you would have hyper-intensive urbanization in China, or to be able to explain it to you like that, it would have helped out so much. What I was saying is, look, they're right. All you have to do is know that earnings growth means that eventually the weight of the energy names in the S&P 500 are going to go from 3% to 12% because of earnings growth. And everybody's going to have to own these names, or they basically fall out of a compliance with their risk manager, right? Because you have to stay in the Morningstar style box. Why don't we just own 11% and have the puck come to us, right? Skate to where the puck is going to go. Yeah. And we were right. And that was a big career trade for me. And we had a couple of guys, portfolio managers, guys from Saskatchewan that made us, right? Yeah. It's the same trade, guys. It is the same trade. Labels are a little bit different. The guys at Goldman get it, right? The guys in the City of London get it. You know, maybe mainstream media doesn't get it, but there are really, really smart people that understand if the dominoes fall, what this means. Well,
I think, just from the whole part about energy, what I get is, the argument Alberta's always made is, we're innovative. We're on top of the technology and the extraction. We actually produce less emissions than most producers, even from the oil sands. We've got it so low, but it's an ignored subject right now. It's like, yeah, but it's oil, so let's not talk. And I think when you get to the point that you're talking about, when they have to go back and look at it, I think we're going to hear that story again. They go, well, we're investing in these companies because, they're in Alberta and they've really taken care of their emissions. So we have to kind of go there because this is just, how we do investing. What we'll do, though, is we're going to be selective. We're going to pick those producers who have really focused on the environment. So we've done it, but we've picked the winners that are really good to the environment the best we can. Like, that's what it's going to end up being to keep both sides happy if you can even achieve that.
So you have the trade. Yeah. So go. This is, so you go through, you get it, and you go, so there it is, right? And so we label it, we package it the right way. The companies are doing this because they understand eventually. These companies have been around for decades, right? They get the fact that maybe in 2050 or look, when you go back and you think why did Trump say that he wanted to pull out of the Paris Agreement? And the reason why, at least the way he verbalized it, and I don't agree with everything, but there is some essence to it, is look at the emerging market cannot wean itself off of fossil fuels. There is no way China and the emerging market in Africa and all these countries can basically wean themselves off fossil fuels. So you and I can buy our Teslas or our green cars and drive around thinking we're great for the environment. Well, India and China pollute, right? So let's be honest with ourselves that the demand for fossil fuels is not going to go down because of the fact that a bunch of people in northern climes are going to be driving electric cars, right? Yep. I'm blunt. Yep. I'm doing a Don Cherry, right?
Yeah, do it.
But they get it. That's the trade. And so why did Trump sit there and go, I don't want to join the Paris Treaty? It's because he sits there and goes, so let me get this straight. All of these regulations get put on us, but the rest of the world can do whatever the heck they want to do in terms of polluting the environment. Why would I want to do that? Now, maybe, and I'm simplifying it down and being very crude, but look at China just increased. They just built massive amount of coal-fired electrical generation last year, right? India is doing the same thing. So if we just stop and look at what is being done as opposed to what is being said on TV, you get the point is, how do we get there? Well, I think it's important that we move towards a net zero. I think it's great that we do this for our kids. It's just going to take a lot longer. That's one. Okay. The transition cycle is going to be hugely commodity intensive. That's two. And three, there's no way we're going to be able to spend for the trillions and trillions of dollars that we're going to need through tax revenue, right? There's no way we can tax, and that's where the MMT comes through, right? We're talking somewhere between 15 to 25 trillion, right? We're talking about 3 to 5% of US GDP every year for at least the next 2 decades, right? You can't tax your way to that.
No.
Right? There's no way. So this is when I write, I say, if Prime Minister Trudeau is sincere, which I hope he is, and I'm taking him at face value, and I think it's an honorable, and when you listen to the Liberals talk, right, and in the convention, the other day, I get so bad at now, I'm I know I'm getting old when I'm flicking channels because I can't say, my Leafs are losing or something, and I end up on C-SPAN, right? And I'm watching C-SPAN. And the other day on C-SPAN, it was Kenny Dryden, right, the good old Montreal goaltender, talking to the deputy prime minister. And they were talking about what? Now is the time for long-term goals. Now is the time to achieve long-term goals. Hey, Mark Carney, right? Good Western boy.
Edmonton.
Right? He is the point man to all of this, right? So I'm the dumb winger now, basically saying just drop the puck in, go in, and get the puck in the front of the net, right? Don't argue. This is what they're going to do. Now, if they change their tune, right? If President Biden and Prime Minister Trudeau and Christine Lagarde and change their tune, and we're going back to the way it was before, where we're worried about wage inflation, right? Then right now we should be selling everything and going into bonds, right? Because we're going to get a massive economic contraction and interest rates are going to go to zero. And if that this is my thesis, and if that happens with the level of populism that exists in the United States, we all saw what went down on January 6th when they marched and they marched on the Capitol building. We're going to get civil war, right? Populism undealt with leads to civil war or world war or revolution. There are 2 million ex-military veterans that are in MAGA in the United States, and they understand violence. See, I got to say that I'm talking to a couple of Western guys. The Westerners, the boys in Saskatchewan and Alberta understand violence, right? You know what I mean? But and I don't mean this, and I don't want to discount it, but there is a powder keg south of the border. It has not gone away. We're talking decades and centuries of oppression that are festering. There are 75 million people down there that feel, rightly or wrongly, that President Trump, the election was stolen, right? And so I'm just saying, when you go to all these self-help guru guys, they say, let's not discount how these people feel, right? There is a lot of hurt down there, right? And populism has even gotten more intense. How do you fix this? Well, this is where I go back to my high school days, right? Where I'm sitting there in high school English, grade 11, and half the guys in my class want to quit and go work at the GM plant at the corner of Pharmacy in Eglinton, right? And make more money than the teachers, right? And what I'm trying to say is it's a good paying job. It's a good paying job that ends that ends populism, not a $1,400 check. And to get a good paying job, we're going to have 4 or 5 years of really strong economic growth. That's how I see that. So to me, it's the populist movement. When you go back in history and look at the rise of populism, that is where you have periods of extreme generational change that we're living through.
You mentioned 2 things I want to talk about still. Bonds, why avoid bonds is one of them. And the second is going to be, you mentioned nuclear. And I think nuclear has always been, environmentalists don't like it, but they don't have a really good reason for it other than there's waste that has to be stored away for billions of years. So I think when you start to see a commodity super cycle and you see where oil is going to go, you might get more acceptance for nuclear. And I think nuclear is probably one of the best, like you said, it's the best out in the short term until we can really convert to a net zero, until you can really get all of your other, wind, solar, geothermal, whatever methods that are going to work to provide the load that we need electrically to make everything work. So nuclear is almost a stopgap, but there's a very old nuclear framework. And I mean, many of this stuff's 30, 40 years old. It's coming to the end of its life. So, but now you can put it in a sub. You should be able to put it in a town of 20,000 people.
Sure. So Bill Gates and Warren Buffett own the technology for Gen 4 nuclear reactors that are those small reactors, right? Yep. And so my opinion is the fact that, the second phase of this this evolutionary process will be around 2030, where we really kick in and have to spend a lot of money on nukes, right? And there'll be small nukes like you're talking about. And I think by then we'll have cracked the code in terms of in a couple of things. First on nuclear waste, and also about the fact that hopefully by then on the geopolitical framework, we don't have such a concern about the nuclear waste being used as weapons of mass destruction. That's why I think we need time. But in the short term, what has happened is there's and I'm going to really simplify this down. There's two main manufacturers, geographic areas. There's Saskatchewan and there's Kazakhstan, right? And Kazakhstan for years just sold uranium, and they didn't care what price. So they were selling for market share, not for profitability. That is over, and now you have the company in Kazakhstan that is their uranium company is now a for-profit organization that's located on the New York Stock Exchange. So it is a for-profit organization that is focused on the bottom line. So we've eliminated an irrational producer. And then what we've also got is the fact that people are just going through what you just went through. You know, Germany, after the Fukushima example, basically shut down all their nuclear reactors, and maybe they're having second thoughts, right? There are nuclear reactors being built in Eastern Europe, but what has happened in the short term is that all the supply has been taken out, and now, you know, demand is start to slowly come back, and what you've got just in the short term is supply-demand imbalances that favor the commodity, and yet at the same point in time, rational producers that aren't going to expand capacity rapidly over the short term because they have to benefit, right? So hopefully Cameco or Cameco, however you pronounce it, they're not going to expand capacity too much, and they're going to basically become profitable. But you know, and I think I wrote about this. When you look at if the Americans are sincere, then they have to replace 30% of their power generation that is based on coal and oil. And to do that, you have to do nukes, and it's going to cost somewhere between $5 and $10 trillion, and it's going to take at least a decade to a decade and a half to go. Think about all the jobs. Think about all the construction jobs. And in all of that, like, look at all the other innovation we have to do. We have to use technology to build out to learn how to build cement in a green way. We will. Technology, you know, let's have faith in science. Same thing with steel. All of these industries will be evolving and innovative. And if they don't, what the great thing about markets is somebody will come in and wipe them out. Because I think what will happen is you'll start to see regulatory changes such that the markets will be motivated to allocate capital into this area. And that's when I say, you know, I say it lightly. This is where President Biden and Prime Minister Trudeau and the regulators, you know, or so the politicians in Ottawa and in Washington need to set the stage so that capital it will come in here and basically help the economy evolve to a green economy. But I don't know who the companies are. I don't know what the innovation is, but we always solve these problems.
Yeah. And with that, I mean, a great answer on that. What's your issue with bonds?
Well, I think we're going to be in a period of time. So if we think that we're going to be successful and that there is a regime change where we do not want to go into deflation and negative interest rates. And that was the same fear coming out of World War II, the exact same fear, right? Then we're going to have a period of time where inflation, people are going to, in power, are going to allow inflation to get above the 2% target and allow it to keep, as long as it's well behaved, go a lot higher. And so what that really means is that interest rates, bond investors, so to be fancy, what it is that you've got those people that have lived and have the memory from the 1980s on because of what Paul Volcker did to bring interest rates down, to have a 3-decade bond bull market, those investors have to flush that memory out. That is not our environment going forward. Our environment going forward is rising interest rates. Now, if it's like the 40s and 50s, we're not going to have to pay the piper until, for a couple of decades. But at the same point in time, making capital gains through declining interest rates in your bond portfolio is over. It's over. That game's not there anymore, right? Right? We're not going to, the rules have been changed. And so that now you're sitting there with 30 to 40% of your portfolio making 2%, and inflation's over 2%. So you've got negative interest rates, right? So I don't know, let's just use common sense, right? Why would you want to own that?
I think the only reason somebody owns is safety.
And this is and that's where I'm saying. So when I talk to people, don't assume that bonds are safe, or don't assume government bonds are safe, right? Yeah. I mean, you've got to these social statements that we come that are just not based in fact are all over the place, right? And so, to me, I understand the volatility in stocks. I get it. I understand the volatility in other asset class. I get it. So you want to own some for stability in your portfolio. God bless you. But you have to understand that it's dead weight towards you, your endowment, you and your family achieving the goals. Now, if your goal is to make 6 to 7% each year, then you have to basically, what is that mixture that you need so that you get solid equity returns and the stability in the portfolio, right? But it's not going to help you achieve your goal, but it will help you reduce the volatility in the portfolio.
Jim, we're just going to thank you right now for your time and your discussions around modern monetary theory and your discussions around how to design portfolios going forward. Sounds like exciting times. I mean, it sounds like it's going to be an economy, in your perspective, that rips out of this COVID pandemic, and governments are supporting that and growing things. So again, thank you very much for your time. How do people find you if they want to listen to your thoughts on a weekly or more frequent basis? How do people find you?
The best way to find your listeners is to contact you guys.
Okay.
And have a meeting with you guys, and then they can access all the writings. And if need be, we can have a conversation to help you solve your financial problems. Other than that, you can go onto the Wellington website, and all my research is posted on the Wellington website.
Thanks for watching this episode of Smokin Bulls, the podcast about business, money, and lifestyle. If you want to learn more about us, find us at smokinbulls.com or on social media.